Hi everyone and welcome to Persian Money channel. My name is Arash Shahriari. I'm an IRS enrolled agent, and in this video I want to go over the tax aspect of different business structures that are permitted in the United States to work under. So there's four major ways. The first called sole proprietor, where you're just an individual and working without any basically any legal entity on top of you, and you're responsible for income tax as well as the employment tax of 15.3% on the net profits of your business. So what happens is that, to give you a quick background on this employment tax, which is 15.3%, typically if the person is an employee of a business, he or she would pay half of this 15.3%, and the other half would be the responsibility of his employer. So under the sole proprietor structure, if you will, since there's no employee, better said, and there's only one person working in liaison, or better said, in lieu of an employee and the employer, that person would be treated on the whole amount, which is 15.3%. The other structure would be a partnership, where same exact scenario applies. There is taxation on income, and also as an employment tax, the same exact thing. It's just that you have partners instead of just one individual operating. Typically what happens is that you file a different separate tax return for the partnership, and based on your percentage of partnership that you own and the treatment that you have as a limited partner or a general partner, you would reflect that income on your personal taxes. The other structure is corporation, also known as C corporation, and the person would be considered the shareholder of the corporation. What happens is that till the year of 2026, corporations, irrespective of the amount of their net earnings, are all subject to the flat 21% tax rate. This corporation is taxed separately as a legal entity itself, and the employees or the shareholders of that corporation also are responsible for their own taxes as the beneficiaries of the corporation on their own personal taxes. Now, if you're the employee of the corporation, so you are basically double taxed. At the corporate level as the shareholder of the company, and second times on your personal return as an employee of the corporation. If you have share of the business and are not an employee, or you could be also both employee and a shareholder, what happens is that you would be entitled to dividends, which if you're a single shareholder, that is, if you're filing as a single individual, up to 40,000 roughly of that dividends would not be subject to any tax. If you're filing as a joint, married joint, up to almost 80,000 of that dividends would not be subject to tax. So that's one of the benefits, that even though corporations have that separate taxation applied to them, the shareholders can take advantage of. One of the in spite of this double taxation, another benefit that corporations can take advantage of is generally referred to as the fringe benefits. There are basically different ways that the company can deduct certain costs of certain benefits that it offers to the employees, and can deduct them from its net earnings on top of the operating and overhead expenses that it has already deducted. So this is another appealing thing perhaps for people who wants to start a corporation. Typically on a larger corporation, this is something that really does make sense because you have a multiple colossal of employees, and those fringe benefits really add up to a significant amount. The other structure that is in place in the United States, and it's not itself an entity, however, the federal government gives it a certain tax treatment, is called s-corp, or also known as small corporation, though the legal name is not a small corporation. It's called subchapter S of corporations. Aside from the legal jargons of that, basically s-corps do a trade-off of certain benefits with corporations, and under that trade-off they're entitled to certain things, and they lose certain tax treatment. The benefits that the S corporation receives is that if the person is a owner as well as the employee of the S corp, aside from the employment salary that they receive, the difference between his salary and the earnings, net earnings of the S corp would not be subject to the employment tax that we already talked about, that 15.3%. Now, before you get any excitement or any ideas, I'm going to point out to a few very important things about this matter, because it doesn't quite seem as an easy way of getting away with taxes as some might believe to be. So what happens is that number one, there is such a thing defined in the Internal Revenue Code as reasonable salary. The whole idea, which is general, is that if you were to hire somebody, or better said yourself as the employee of this company, were to get that job elsewhere based on the, what is the normal market salary that would be designated for you, you have to pay yourself the same amount of money as well. You can't just cut corners here, there, and leave more room for that profit, net earnings profits that can be exempt from the employment tax that we mentioned. So speaking of that, if you happen to be the only employee and person operating the whole company, technically the whole 100% of that earning should be considered your salary, and thus there's no room actually, ideally anything left out that should be left out that could be exempt from that 15.3% employment tax. However, if you have other employees that also pitched in your success, or independent contractors that were involved in this operation, there is, in the same allocatable and proportional amount, room for taking advantage of this exemption that applies to the net earning. One other thing about S-corp is that because of this attractive feature that and benefit that I just mentioned to you, is that they cannot have more than 25% of their earnings from a passive activity, such as rentals. This is another important thing that you have to keep in mind. If that 25% threshold is crossed over, the S-corp technically loses its status and is subject to the corporation tax rate. Trade-off that the S corporation loses is the fringe benefits. The owners that happen to be the 2% and more owners of the S corporation cannot take advantage of deducting any of those fringe benefits, which is usually the case, given that to begin with, one of the criteria to qualify for the S-corp status is that there shouldn't be more than 100 resident owners or shareholders of the s-corp. So I hope this video was helpful for you. I definitely recommend you to always work with a tax professional, given that there's a lot more into these stories than what I just went over, and it's definitely worth your investment that you put into. I'd be happy to assist anybody who's interested in taking care of their finances and taxes. My contact information is in the description. I wish you well. Have a blessed day.